let's talk about the jobs number. We did get a jobs report that was right about in line with expectations, a gain of 49,000 jobs for the month. That was below what you were anticipating. And there is a lot of question about how deep the scarring is that goes into this. Where are you on the economy, and what do you think we need to see from Washington?
Well, listen, I think, Joe just said it. We're still 10 million people short of where we were a year ago. We had, I think it was 153 million people on non-firm payrolls. We're now about, 143, something along those lines. And so it seems to me there's going to be some structural unemployment problems after this is over. Now, by the same token, travel and leisure, other things, as the economy reopens, that's going to be the best jobs program you can get. My own opinion, and maybe echoing what Steve was saying about Larry Summers, is that, we may be overdoing it here because there's still $1 trillion we haven't spent from the last round of stimulus. We're talking about another 1.9 trillion perhaps, and personal savings is $1.5 trillion higher today than it was a year ago. And so, and then you add into that opening up the economy, and I would think my hope is that a lot of the people that are unemployed will get jobs, pretty quickly in the second half of the year. Then you may have other issues like inflation and other structural issues that I think people are willing to worry about that when it comes. But there is a chance, in my opinion, from Washington perspective, we're very close, if not past the point of overdoing it.
Jason, even what you said before, that you're not going to worry about where stocks are, where valuations are, until you get past 2 or even 3% on the 10-year. I mean, that still sounds like such a historically low number. What is it that starts to worry you at that point? Is it how quickly we get to those levels, or how quickly we get to levels beyond that?
It's Becky. It's really it's a good question, because I think it's really the pace at which we get there as opposed to the levels. Because normally what happens when a market peaks is that for a while at least interest rates go up at the same time the stock market goes up, and people are willing to deal with the fact that you have higher interest rates because the economy is growing, and so you have nominal interest rates that move up as a reflection of that. The problem is, again, you're trying to get a fair value between the bond market and the stock market. I mentioned March of 2000 earlier today, or earlier before, and the 10-year Treasury yield was 6, but the earnings yield was only 3, and so you were, stock market was very expensive. Here, again, you have a lot more to work with because the equity risk premiums we talk about is positive by 200 or 300 basis points. So it's going to take 200 or 300 basis points for people to really start get worried about equity valuations, but the pace matters. So if you get there, again, if we get there by the end of the second quarter, I have a feeling multiples are going to come in. Even though the earnings may be good, multiples are going to be quite a bit less.
Shepard Smith here. Thanks for watching CNBC on YouTube.